Hi there. So what I'd like to do is just give a little overview of the Heritage Doll capital budgeting finance simulation that you guys will work on this week. In general, if you take your time and take this seriously, this will take approximately anywhere from an hour to an hour and a half to complete. So as you can read, and you may already have logged in to the simulation, which was in review mode up until today. You'll see that you are the head of the capital committee, the capital budgeting committee. And as part of that, you are responsible for deciding which projects should receive funding. Right? There's no limit to the number of projects that can be funded. Okay, so we're not talking about mutually exclusive projects. You can select 1, 2, 3, 4, as long as you don't exceed the capital constraints that are presented to you within the simulation. Okay, so you're going to be provided with a number of pieces of data around each of the projects and financials for Heritage Doll. Okay, and you're also going to find that a lot of projects are going to be available for investment during more than one fiscal period. Okay, so you're going to have to take that into account when you get into the project analysis. Right? So as you prepare, you can go through the how to play. I'm going to walk you through all of this kind of right now anyway, but nonetheless, there's still some information here if there's something that you're not understanding. Okay, there's some information around Heritage Doll. Mostly you already know it because we've already done the case, so great job. And if there's anything that you would like to review in terms of an introduction to this simulation that I'm not providing, there's also an intro video for you. All right, so when we get into the simulation itself, all right, you're going to be looking at the Analyze tab, okay, before you get to the Decision tab. All right, and here you're going to be presented with a dashboard. Right, again, this is covering the period from 2009 to 2014. Right? You're given revenue, operating income, and net income for 2009, and obviously current. Okay, but we're in 2009, actual versus forecast. We have cash flow by division, okay, between production, retail, and licensing, and the splits based upon revenue for each of the 3 different divisions that exist there. All right, so you can see that the retail division has the highest split in terms of revenue, followed by production, followed by licensing. Okay, you give some information around the income statement and balance sheet, okay, for a consolidated point of view, as well as for each of the 3 different divisions. Okay. Right. You have the ability to copy this data to the clipboard, export it to Excel if there's anything that you would like to analyze offline. You have access to the cash flow statement, very similarly to what you saw on the income statement balance sheet for each of the 3 different divisions and a consolidated view. We have a look at some of the financial analysis around the different financial statements. Free cash flow, discount factors, discounted cash flows, debt-free enterprise value, okay, terminal values, all right, present value including interest tax shields, all right, 5-year cumulative EBITDA. We saw this within the Heritage Doll case that we did and within the valuations that you presented and provided, okay, and we have that at a consolidated level as well as for the individual divisions themselves, okay. And then we're kind of given some information that is specific to each of the projects that we're going to be looking at having to decide upon. Okay, so we have, in this case, 1, 2, 3, 4, 5 different options, 5 different projects that we are looking to analyze. Okay, and each of these projects is going to have a project discount rate. It'll have a little description of what the project is and what risk level, okay, is associated with the project. Right? If for some reason that you look at this and you say, okay, hey, this is a low risk project in the production division, all right, how do the other discount rates factor in? You can click on this little table here and it will provide you with the different discount rates. Okay, so the corporate discount rate is 7.85%. Now, one could say that, okay, this project is considered to be low risk. It's within the production division. Therefore, what I'd like to do is I'd like to adjust my discount rate, okay, to 7.7, because that is in line with the risk level of the project. Okay, and there's nothing wrong with having a discount rate for a project that's lower than the discount rate for the company itself. Okay, so you can adjust the discount rate for each project, and then you're given the projections, okay, around the project. All right, incremental. Remember, we've already done this. Incremental, the project income statement, what the net sales are for the project, what changes in SG&A are a result of the project. Okay, so you'll get to see all of the additional information, okay, related to the project itself. Okay, so taking what you already did with the DCF for Heritage Doll with the 2 projects, and now being able to look at it through the lens of multiple projects. Okay, you're familiar with NPV, you're familiar with IRR, what the discount rate is, payback periods, profitability index. Okay, so you've got metrics that identify what some of the decision-making criteria are for each of the projects that are being evaluated. Okay, you can go back and look at the historical financials. So as you add more years to the simulation, you'll be able to see the impact, okay, that your decisions have had on the historical income statement, balance sheet, and cash flow statements for Heritage Doll. Okay, and then if there are any updates that will come in subsequent years about the success or lack thereof of the projects that you've chosen, those will show up here on the project updates tab. Okay, so here's all of kind of your base information, and then you've got to make your choices, right? Now, there are going to be two different scenarios here. Okay, you're going to have projects that you're going to be presented with. Okay, and you are going to have to decide, okay, which projects you're going to do. Okay, and you're going to have 2 different scenarios that you're going to be operating under. Some of you are going to be operating under scenario A. And scenario A is you get a flat dollar amount of capital money each year, okay? Which means there's no EBITDA carryover, okay? So you don't get a percentage of EBITDA that you generated as a result of your decisions, okay? In addition to a base number. You simply get, as the case is here, $8 million. That's your constraint, okay? So some of you will be operating under that scenario A, where it's just fixed every single year, okay? Some of you will be operating under scenario B, okay, where the fixed portion of your capital allocation will be declining every year. Okay? But you can make up for that declining capital allocation through an increase in EBITDA based upon the decisions that you've made from the projects that you've chosen. Okay, so you're on a declining scale in terms of your fixed capital allocation, but you can make up the difference, okay, by adding EBITDA to the bottom line. And then you get a fixed portion of that additional incremental EBITDA of 25%. Okay, so as EBITDA goes up, you get more capital allocated back to you at a rate of 25%. Okay, and then you get to carry over some capital to the next year if you don't use it all. 15% of what you don't use gets carried over. So some of you are on a scenario A, fixed capital expenditure. Some of you are on scenario B, okay, where you have declining fixed, but you get to make it up with added EBITDA value, and then you get carryover at a rate of 15%. Okay. So in this case, just for the example, okay, we've got NPV metrics, IRR metrics, profitability, payback. You can kind of see what lifetime project costs are, okay? So let's just look at it for a second here, okay? We've got the new doll film DVD, all right? That's the highest NPV, definitely the highest IRR, huge profitability index. The payback is really light, but how much does it cost? Well, let's take a look. If we click on the box here, okay, it tells us that we went from our budget constraint of 8, okay, to 6.95 remaining, okay? So we have plenty of budget left, so we can select another project if we would like, okay? So the 15-year EBITDA is huge, okay? We lose money in the first year, all right? But we have a significant possibility of making some pretty additional added value, let's put it that way, okay, to the business, all right? So we could select this, and let's just go randomly grab another one, the Match My Doll, okay? All right, which leaves us with 2.38 remaining. All right, so are we able to do anything else? We could do the toddler doll accessory line if we wanted to. Let's just leave it at that, okay? So we can get to the next point. So we're gonna do the Match My Doll, and we're gonna do the new doll film DVD, all right? And we can go back here to the Analyze, all right? And we can look at the Match My Doll, okay? See, now they've fallen under selected projects. So now let's go look at the Match My Doll. Okay? And we can kind of see what the sales are going to look like. And what we care also too about, if we're on the scenario B, is what does EBITDA look like? How does EBITDA move up every year? Because remember, you're going to get 25% of the incremental difference of EBITDA as additional capital to spend if you're on scenario B. Okay, so that looks good. And we have the new doll film DVD in licensing. Project is medium risk. So let's just check the discount rate there. We got the corporate, but if we're in licensing and we're on medium risk, let's just take a look at the 7.4. So again, we're just kind of going back and checking to make sure that the projects that we're looking at, okay, match up with the level of risk that we're taking from a discounted cash flow standpoint. Okay. All right. So we go back to decide. So we're going to go ahead and choose these, and we're going to submit the decisions. Okay, right? So what did that do to our business? Well, our actuals came in above our forecast for revenue. Okay. We had operating income that came down, which is great. So net income is 12.68 currently versus what it was in 2009. Okay. Revenues, we can see what that looked like. Our annual budget, okay, we have 8 available. We've only used 0.03 because remember, we had some ongoing capital expenditures from each of the projects. All right, so we're consuming some of our available capital from the projects, okay, that we selected. We got some project updates. Clothing line outperformed expectations. The film was released on schedule. It was successful. DVD sales exceeded those of New Heritage's previous films. Okay, so you're going to get this every single year, right? So you can kind of track to see what the progress is of the decisions that you're making. Okay, so again, blah, 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 same stuff, same income statement for 2010, cash flow statements, financial analyses, project details. Let's go there now. Okay, well now, okay, now you see we've got new available projects. Okay, we still have the ones that we've done, the previous projects, right? But now we've got some new projects. What about Grow With Me doll line? All right, we've seen that before somewhere, right? Warehouse facility consolidation. What's that all about? So click on that. We're going to consolidate warehouse facilities company-wide, okay? Saving on operating costs, increasing distribution speed. That seems like it might be something worthwhile to look into, okay? Medium risk from a retail division, check the discount rate. Retail division, medium risk, oh, that has a significant change in our discount rate, okay? This is very important that you keep track of this. Don't just simply use the corporate discount rate because we need to make sure that we're evaluating the projects based upon each project's own individual level of risk as it relates to the broader corporate discount rate. Okay, so we changed the project discount rate. So you're going to have to evaluate these different projects, right? And then we get to the decision, okay? And we have to decide. We got to make decisions again. Okay, we've already done the Match My Doll and New Doll, right? Which consumed what is that, $300,000, no, $30,000 of capital expense. So we've got 7.97 left. So we've got to go in and select the most appropriate project that we would like to do, or projects if they're not mutually exclusive. You can select multiple projects. Okay, so let's just go in and let's, for the sake of speed here, let's just select the one with the highest net present value, 12. Do we have enough money to expand the new East Coast distribution facility? Oh, we don't have sufficient funds in the budget. So sorry, we can't do that. Okay. What's the next highest, just for the sake of expedience here? 12, 10.64, the Grow With Me doll line. Do we have enough? Yes, we do. And we have just enough. All right, we have 1.4 remaining. All right, and you could go in and you could see if there was any other ones that you could do that could fill in that additional 1.4. But for just this example, we're going to keep it. At just the Grow With Me doll line. So we're going to submit the decision. So our 2011. Okay. So how'd we do? All right. So we started in 2009 with 245.75. We're now currently with top line revenue of 270 million. Great. So we're above our forecast, right? We're above our forecast on net income. Okay. We can see that our cash flow by divisions, okay, really started to pop up. Okay. Our project updates. Bummer, dude. Unexpected quality problems caused first year revenues to fall short of expectations by half. Oh my God. Okay. Higher return rates and costs associated with re-engineering a key electronic component raised operating costs significantly. Okay. We can see the operating cost here changed drastically as a result of what happened with the Grow With Me doll line. Dude, this stuff happens. It's real life. Nobody knows what's going to happen until we flip the switch and turn things on. Okay, so we've gone through 2 years. I think you get the picture as to how we go about the simulation. The goal here, right, is to maximize value for the firm. Okay, to maximize value, right? In the end, we're going to have reports that get generated that show us where we started at, how much cash we used, what the net present value delivered to the firm was for the projects that each one of you selected. Okay. Our goal is to maximize shareholder value through this simulation. Okay? You've got until next Monday to figure it out, to go through it. All right. Again, this is simply giving you real world simulation experience with capital budgeting decisions to see how those decisions impact the overall net profitability for the Heritage Doll Company. If you have any questions at all, please feel free to reach out, but we will kind of do a simulation recap when we get into class on Monday night. I appreciate everybody's patience from last night, and I will see everyone next week.